And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the second best day of the week. Of course, it's Thursday. Michael Lee was joining me this morning. We'll talk all about interest rates and the interesting kind of conundrum as of late for a lot of people. I'm getting a lot of emails over the last few days on why are interest rates going up when the Fed just cut rates? And we've talked about this at numerous times before, but we'll go over it again with Mike today, kind of explain what's going on with rates. And we'll also talk about some advantages to take advantage of in terms of where interest rates are headed and some of the opportunities that may be out there and things that we've been doing in our portfolios of late. So we'll get into that this morning. Outside of that, economic data today. Today and tomorrow, we've got a lot of economic data, PCE prices tomorrow. That's going to be the one thing that the market's going to kind of really look at in terms of is inflation coming back or not. And today, there's just a whole slew of Fed speakers. I think there's 5 or 6 different Fed members out today speaking at different places. So there's going to be a lot of commentary coming out from the recent Fed rate cut meeting about, and again, the markets are going to be parsing this data. Is like, is there more rate cuts coming? What does this mean? Why did the Fed cut 50? And, all these type of things. So again, there's going to be lots of stuff out today that the markets are going to be kind of chewing on. So again, just kind of expect a bit of volatility today. Markets have had a decent run here. So again, a bit of a consolidation around this recent breakout would not be surprising. A retest of the previous all-time highs to kind of cement that breakout, create that support level. Won't be surprising. So again, we'll kind of see how this goes over the next few days. Next week, pretty much everything moves into blackout for corporate buybacks because the week after that, we're going to start Millennial Earnings season. And it was funny, yesterday I was doing an interview with Charles Payne on Fox Business, and he made the comment that, we should be getting close to the time that the analysts start cutting estimates so we can, have all the companies beat estimates for earnings. They've already done that. Over the last 2 weeks, there's been a very sharp downgrade in estimated earnings for third quarter. So we'll be putting out a chart on that here in the next few days. I'm going to write something up on it for you. But again, that's just kind of not surprising as we move into the earnings season. Got to have all these companies beat earnings. Speaking of beating earnings, though, there's been a lot of talk lately about the AI. The AI trade is dead. There's the demand is failing and all this. Well, Micron put that concern to bed last night with an absolutely stellar report and very strong comments about the demand for AI now. Micron supplies chips that are used in other areas of AI. So you have NVIDIA, you've got AMD. NVIDIA, as an example, builds the GPUs. Micron provides the chips. So again, a lot of demand for Micron in those chips. That came through in their earnings report last night. That stock's going to be up 14% this morning. So that's going to kind of drag the rest of the AI space up with it. So again, there's been a lot of concern lately. We really kind of have said, it's really way too early to be calling the AI trade dead because this is one of those things that's going to take years to develop. And as the demand spreads from just a few mega companies right now investing billions into building out AI data centers, et cetera, that's going to start to spread across small and mid-cap companies all across the space just to play catch up. One of the interesting charts out this morning on our Twitter account is where the CIA, the CIA. They have a company called InQtel, which is their investment arm of the CIA. They are mostly investing right now in AI, cyber, and hardware. And don't laugh at them because their portfolio doubled over the last couple of years. So they're doing very good at their investments right now. So, but yeah, if you want to know where the CIA is investing, go to our Twitter account or to Substack at Lance Roberts, either place. And I've got those charts up for you this morning. on both locations, so you can see that. Okay, let's talk a little bit about the markets. Here's what you need to know before the bell. Yesterday, we talked about this short-term kind of cup and handle formation it's technically very bullish. We just broke out of it, so we've confirmed the cup and handle. And we talked about yesterday is that typically leads to higher prices. And again, this is why analysts right now are targeting 6,000 on the S&P by the end of the year. So again, everybody's very bullish right now. This year in particular is the second largest year of equity inflows since 2014. So it's been a very big year. Foreign inflows into U.S. stocks has been just ginormous. But inflows overall are very, very high. So if you're kind of keep wondering, like, why does the market just keep going up despite all this other concern? That's why. Everybody's flowing money into the markets right now and pushing asset prices higher. So no matter what your other theses are, flows trump thesis every single time, and that's what's happening here. But here, let's talk about something interesting. So we talked about this cup and handle formation yesterday. Last night, I was doing a little bit of longer term analysis on markets, and I had remembered that we had talked about the cup and handle before, so I went back and kind of looked through some of our previous writings, and indeed, I talked about this cup and handle formation before. It was back in October of 2023 when we talked about, hey, we're about to have a fairly significant rally in the markets. We talked about increasing our allocations to equities. But that was on a weekly basis. We had this very nice cup and handle formation on a weekly basis. So we went through that bear market or correction rather in 2022, came out of it in late 2022, retested, had that 10% decline in the summer of 23, which formed the handle of that cupping pattern. And that is really kind of technically has been the driver for this elevation in the markets here over the course of the last year and a half. Now, here's what's interesting about this. As we're talking about this, we have a really interesting negative divergence that's now popping up. So we've got this really nice bullish uptrend to the markets right now, but we have both a negative divergence in both relative strength and momentum. Again, these negative divergences are good indicators that we may be getting closer to the end of this move. And again, 6,000 certainly the proper target right now for this particular move, but we may be getting closer to the end of this move than not. Pay attention to that negative divergence, because again, if that doesn't correct itself, that typically precedes downturns in markets. In fact, the last time that we had a negative divergence was going right into the peak of the markets in 2020, late 2021, early 2022, when Russia invaded Ukraine. We had that same negative divergence setup, and then of course we went through that corrective cycle in 2022. So again, we may be getting closer. This was something that won't kind of, again, weekly charts, monthly charts, those take a long, we talked about earlier this week, monthly charts on gold and stocks are extremely overbought, but those take a long time to play out. But again, kind of keep a watch on this negative divergence, because it does suggest potentially that probably next year we're going to get into a cycle where markets are going to have to reset a bit, unless the markets can resolve that issue without correcting. So normally it doesn't happen, but we'll see what happens. But pay attention, those negative divergences on relative strength and momentum does suggest that this kind of rapid inflow of capital may be starting to slow down a bit. So again, flows trump everything else, and we'll keep a watch on that. So, all right, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
By the way, if you're watching our YouTube channel this morning, we appreciate you being here. The cost of admission is to click the like button. So please do so. So a couple of things, Mike. Obviously we had the 50 basis point cut last week, and again, there has been lots of commentary, since then about what does this mean? The Fed cut 50 basis points. Does this mean, inflation's coming back, and of course we'll have some PEC data, some price data today and tomorrow to look at to see if that's the case or not. A lot of other things have been happening, around this. And I thought it was interesting today. And again, you've got to be so careful of headlines because this morning Bloomberg had a headline out that says mortgage refinancing explodes as the Fed cuts rates. Well, you got to be really careful of that because over the last few years, we've had no refinancings. Nobody's refinancing anything at higher rates. So yeah, if you go from one person refinanced last month to two people, you had 100% increase in refinancings, right? So you got to be really careful with, in any index that is working off a percentage change off, of the last couple of years, particularly like in mortgage refinancing or home sales, anything like that. There's been such a low level that now it's going to look like things are just absolutely exploding when they're really not. We're just, picking up a few extras. So again, but there are going to be some impacts from, lower interest rates, no doubt about that. People are going to be able to refinance, mortgages if they got one at a much higher rate. They're going to look for an opportunity to lower that rate, and then they're going to wait 12 months and try to lower it again, right? So we're going to see serial refinancers as rates continue to come down. But Mike, outside of some of the kind of the obvious things, there's kind of a lot of concern that the Fed is cutting rates by 50 basis points, and that there may be something else kind of going on that maybe we don't know about yet, but maybe that the Fed's actually concerned about.
Yeah, it's really tough to tell because so far this is not the normal cut. The normal cut is to spur the economy. The normal cut, at least, over the last 20, 30 years, was to increase inflation. I think this is the normalization cut, at least in the eyes of the Fed and Wall Street, right? The reaction from Wall Street last week, remember, the Fed came in, the market was down, 10, 15, S&P was down 10, 15, 20 points. Closing the day of the Fed meeting, and we came in the next morning, I think it was up, 70, 80, 90 points. Right. And it really hasn't looked back that much since then. So I think the mood, the sentiment prevailing is that this is a normalization. The Fed wants to get rates back down to a more normal rate given the economy, given inflation. and that looks more like 3%, 2.5%. We can kind of argue what that rate is. Excuse me. But it's not zero, as we've typically seen when the Fed starts cutting rates, which would be much more of a recession rate. So despite, there's plenty of economic data out there. Some is good, some is bad. It's kind of all over the map. And it's kind of an easy time to be bullish or bearish because there's a lot of supporting data. Mm-hmm. But we're in kind of flux. The economy is slowing. But again, it's a process of normalization too. So you can, again, kind of speak on both sides of the argument. But look, at the end of the day, I think the Fed is normalizing rates for now. They may have to keep normalizing them down to zero. But I think the way the market's treating this is as the Goldilocks landing scenario where they just land the plane perfectly, get the economy down. And there's going to be weakness in the economy as that happens. There's also going to be strength in the economy, right? Potentially home builders start perking up a little bit, selling more homes, the real estate market in general. So, we kind of have to take this for what it is pay close attention because there certainly are disturbing signs of weakening in the labor market, which can certainly tip a good economy into a recession. But as investors, we also have to appreciate what the market is telling us. And that's what's going to drive the market until there's a new sentiment, new thought about what's coming down the pike.
Well, no, and that's what I was talking about this morning. If you take a look at it's kind of quite amazing, actually. And I posted a chart on Twitter and Substack this morning talking about, just inflows. And it's just quite amazing that, how much money has just been flowing into the market. And now this is occurring at the same time, right? We have all these inflows into equities. At the same time, you've had all these inflows going into money market funds, right? So you think about you've had over $1 trillion going to money market funds, chasing 5% money market yields, which was not surprising. But at the same time, you've had just a massive flow. And again, as I noted earlier, this is the second largest year of inflows into the market since 2014. So it's just been this massive flood of money. You just have to kind of wonder, like, where's all this money coming from, right? It's just an incredible flood of capital. And it's not just retail investors or pension funds. I mean, private equity funds are sitting on nearly $1 trillion worth of powder that they've got to invest at some point, right? And so they're trying to get that money invested in different places. So it's just quite amazing. And again, no matter what your thesis is, flows are going to trump everything else, right? If people are putting money into the markets, they're going to keep going up. And it's just been quite amazing. Whether it, and again, this goes back to our conversations, Mike, we've had before. There was a lot of people running around like AI's dead and the AI stocks are over. And, we always hear these things, when there's a big run and you're particularly early in the cycle. But just the passive indexing flows alone, which dimension funds and systemic funds make up a massive chunk of those inflows. That just keeps pushing. It's 35% of the index is 10 stocks. And so every time a dollar goes in, 35 cents of every dollar goes into those 10 stocks. And it just keeps pushing them higher and higher. So, it's hard to build a real bear market narrative. Yeah, there's lots of concerns out there, but it's hard to build a bear market narrative when you have that kind of capital flood. And it's not really a flow, it's a flood of capital just coming into equity markets from all over the world. It's not just domestically. Foreign inflows have been a huge flow into U.S. markets over the last really 2 years in particular, but this year more so than anything else.
It's kind of like the housing market is all about, as they say, location. Mm-hmm. Stock market is all about liquidity. We can build a bearish economic argument. That's not that difficult to do right now. But the stock market is based on sentiment. And if investors think stocks are going to go up for whatever reason, whether it's because the economy is booming or whether it's because the Fed is injecting money or because money flows are increasing at a rapid pace or buybacks or a number of other reasons, or because Trump's going to win, or because Kamala's going to win, or because someone's going to win. It doesn't matter. That liquidity is flowing into the market, and we have to, appreciate it. And it's, at times you can have a bearish economic forecast and a bullish stock market forecast. And there are other times where you can have a bullish economic forecast, but the liquidity just warrants a more bearish or, more conservative stock market forecast. So, we're kind of pushed to having to separate what we think about the economy. And the economy is still in a recession. I'm not saying we're in a recession, but I mean, we're still in a good, decent, growing economy. We're not in a recession. But, you have to kind of do that mental tug of war, but appreciate that money is just flowing into the stock market, that money is buying the AI narrative, that China is grossly stimulating their economy. It may not have an effect there, but it could have a big effect here. So there's a lot of variables. And you have the Fed that's cutting rates, which is seen by the market as a very good thing, even though historically over time when they cut rates, it doesn't always work out so well. But, we're in the one out in the top of the first inning of a rate cutting environment. So, you're not really losing yet, so, just appreciate the liquidity, because liquidity drives market, and there's a lot of liquidity out there right now, regardless of the economy.
That's right. And this is that big challenge is, as we talked a little bit about yesterday, consumer confidence just took a big downturn. I'm writing on the newsletter this weekend, kind of covers the correlation between consumer confidence and the stock market over time. And, Ben Bernanke, famous back in 2010, the reason that the Federal Reserve did quantitative easing was precisely, in his words, not mine, to stimulate consumer confidence, which will stimulate economic growth, right? So put more liquidity, lower rates, and that makes consumers more confident because they have the wealth effect goes up and they spend more money in the economy. And, it's fascinating right now that there's one of the largest divergences that I can find historically between consumer confidence, where it's currently at, versus the stock market. So, and again, it's just this, there's a lot of these, right? The yield curves, the leading economic indicators, consumer confidence, and really the spread in particular, the spread between consumer confidence, present situation, and future expectations is rising sharply. That has 100% perfect track record for predicting recessions, but yet there's really no sign of a recession. And this is that whole point that we're at right now, which is, well, this time's got to be different, but we'll see. But Mike, when we come back from the break, I want to talk a little bit about bond yields, particularly Treasury yields, which have been coming down here, Treasury yields was going up here as of late, bond prices coming down post the Fed rate cut, and now everybody's asking the question, why? Shouldn't those be falling in tandem? We'll talk about that with Michael Leibowitz when we come back. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment starts October 15th. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my kids know that I do radio, but they don't listen to it or anything. This guy sees me in the airport. So now my kids think, it's like, oh my gosh, my dad's really
famous.
He's famous, right? Yeah, it's awesome. He's famous.
The Real Investment Show podcast.
So we get in the car and we find a Red Robin. It's packed. We've been there maybe 5 minutes. He comes over to me. He's like, come on, I got you. Puts us in a private room at Red Robin.
You know you've made it when you're an A-lister at
Red Robin. Exactly.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Somebody in our chat just asked, what is Red Robin? Well, you must be a foreigner if you don't know what Red Robin is. Red Robin is a, they're not, I don't think they're that big of a chain. They're a fairly big chain, but it's not like a, kind of like a Burger King or a Jack in the Box. They're not nationwide, I don't think.
Kind of like Southern Regional.
Yeah, I think so.
Yeah.
It's basically, it's kind of a sit-down dining establishment. It's not fast food, but it's hamburgers and bottomless fries and that type of thing. And it's good food, but I mean it's not upper tier restaurants. It's and it's not really it's not fast food. It's somewhere between fast food and maybe mid tier.
Yeah.
So somewhere around there.
It's a Buick compared to a Chevrolet.
Yeah. Yeah. More like a Mazda versus a Cadillac. But yeah.
Hey now.
It's a Chili's versus a McDonald's.
Yeah, there you go. There you go. See, Michael comes through in the clutch.
Yes.
Chili's versus McDonald's.
And we have Red Robins.
Do you have Red Robins?
Yeah, we have them up here.
Okay. Maybe it's a northern thing that's just working its way south. I don't know. But
they're good burgers.
They are good burgers.
Oh,
but
man.
yeah, I think we have one or two in Houston, and then I can't really call it a commercial. What do you call it? Promo for the show?
Oh,
yeah, on the show.
The promo.
Yeah, that was when I was in Utah on vacation. We ran into somebody at an airport that recognized me, and then we wound up at this Red Robin, and then that's the whole story behind it. But anyway.
Hilarity ensued.
There you go. So a couple of things. Let's talk about bond yields because, the Fed cut rates last week, and ever since the Fed cut rates, bond yields have been going up, bond prices going down. So, I've been getting a lot of emails the last couple. Like, I don't understand why yields are coming. Yields are going up, and the bond. The Fed just cut rates. Or you said that when the Fed cuts rates, that bond yields fall. Slow your roll, man. First of all, what happens on a day-to-day basis in the bond market is irrelevant, because it all has to do with long-term impacts of economic growth and inflation. So, when yields do one thing one day, like if some economic report comes out and then yields are up or down that day, it has nothing to do with anything other than positioning in the market. That's all that's happening is that, maybe there's a bond auction or somebody's needing to hedge something, whatever it is. So bond yields can, from one day to the next, can do things that don't have any normality to anything. Over the long term, they track inflation and economic growth. That's it. So if you want to know where rates are going, simply map out where you think inflation and economic growth is going to be, and then you can make your prediction for where interest rates are going to be with fairly decent accuracy. So the Fed cut rates on Wednesday, and we've been talking, Mike and I have both been on the show talking about, for really kind of Mike over the last couple of months, that bond yields were extremely overbought. There was a big chase into bonds before the Fed rate cut. Yields were 4 standard deviations overbought. I was on Adam Taggart's show saying, hey, it's too late to buy bonds because they're so overbought. Something's going to trigger a correction in yields, whether it's going to be an inflation print that comes in hotter than expected, whatever it is, there'll be something that triggers a bit of a sell-off in bonds because they're so extremely overbought. Technically, have to correct. And this goes with the same conversation we had yesterday or the day before, I can't remember now, on gold and stocks. On a monthly basis, gold and stocks are extremely overbought. They are going to correct with some magnitude at some point in the future, right? It's just a function of how technicals work. They cannot remain this deviated from long-term means for that long. Bonds were the same way. So we're now having this correction in bond yields, and now everybody's panicking because it's like, oh my gosh, the yields are going in the wrong direction. The Fed's cutting rates. What does that mean? And it doesn't mean anything in the short term. But Mike, I'm going to let you weigh in on this. That's just my opinion. Go ahead.
Exactly what you said. We were, I think the Fed meeting was the typical buy the rumor, sell the fact moment. That everyone's anticipating the Fed is going to cut rates. The Fed's telling you they're going to cut rates, buy bonds, buy bonds, buy bonds. Liquidity is flowing into bonds. They actually do it. And those people that bought them sold them, right? The market got very overbought short term, not over the long run. Still think rates are going to keep coming down, but it needed to take a break. There needed to be some profit taking. And bonds are getting to a much healthier position today than they were exactly a week ago. So, in some ways, for those of you that haven't bought, that wanted to buy more bonds, but were kind of listening to us and we were saying, look, I know yields keep going down, but this is going to stop. They're going to back up for a little bit. This may be a gift, a chance to add a little bit more bond exposure to your portfolio. So, you just have to be careful not to look at the last few days or even few weeks, especially in a bond market, and determine that bond yields are going much higher, because bonds are very, like you said, well, Lance, they're very based on economic growth and inflation growth. And there's really nothing that tells us the economy is going to start surging again. It's not going into a recession right now. Estimates are still around 3% or so, give or take a little. And there's still plenty of signs that inflation will start coming down. We'll get another look at that tomorrow with the PCE prices index. And we'll get jobs data the following week to help us with the economy. But
real quick, Mike, article out today about to get a huge downward revision to GDP as well, which could also help bond yields. Go ahead.
Right. And if you look at it from a technical perspective, it's worked off a lot of the overboughtness. So now it's probably waiting for now what you want to see is a change in sentiment. Bond yields aren't going to the moon. They may start coming down. The Fed may start cutting rates more. PCE was lower than expected. You need that jump to kind of push bond prices back up again. And resume the trend that they were on, but at a little more of a sustainable pace. Lance, we're going back to kind of our first segment. There was something I was thinking afterwards, and it kind of pertains to this too, that in hindsight, markets make a lot of sense, but they don't always make a lot of sense when you're living that moment. So, a year from now, we may look at this rally in the stock market and say, yeah, that made sense given what they were thinking then. But then you see it, in May or whatever, it fell a lot as the market came to grips with X, Y, and Z, or it kept going. So, just be careful, because this will make sense someday, just not today.
Right. I think that's such a hugely important point, Mike. We talk about, markets and cycles and you and I both do this, right? Well, historically, every time this has happened, X,
right.
Every time X has happened, Y has happened, right? And it's always so important to remember that, every time is different. The things that make up a certain rally or whatever are always different. Outcomes are almost always the same ultimately, and particularly from a technical basis. And, this is why you and I pay so much attention to technicals. In fact, we've had a pretty, over the last few days, I mentioned this on Monday or Tuesday, I can't remember. And since then, I've got just a ton of emails. People kind of want just a basic primer class on the show one Thursday of just technicals, just understanding basic technical analysis, how to use it, et cetera. Because, we do talk a lot about technical terms. And a lot of people have no idea what we're talking about. So, that would probably be helpful at some point. But, and again, this is, why paying attention to price, which is simply just a measure of psychology, is so important. Because as we look back, and again, it's easy to look back and just say, well, this happened and, that caused a recession. And just because it hasn't happened yet, A, doesn't mean it won't, and B, doesn't mean that this time is different. It's just, and again, there's so many narratives right now. And in fact, I've been just going back and forth in the chat on we're talking is like, well, gold's different this time. Well, no, it's not different. We've been through these phases before, and if you go back in history and look at when you go through these psychological phases, they eventually, the price is correct because it's just part of the cycle. And it's very interesting that, we have these cycles, we have, these normalities that occur in the market, and, technical analysis, price analysis, understanding what's going on and tying this all together is important for kind of navigating markets over time. It's easy to get swept up into a narrative for stocks or AI or whatever it is, but this too shall change at some point in the future, and we've got to be aware that will happen and then make adjustments accordingly.
Technicals, look, at the end of the day, technicals are really just about quantifying human behaviors. It's understanding where there are a lot of buyers or where there have been sellers in the past, and understanding that people get greedy when things go up and they get fearful when things go down, and they react differently in those fearful moments and those greedy moments. And technical analysis helps you appreciate what levels, what prices will create more greed, will create fear, will put winners in a losing position, will put winners in an even better position to get greedier. And, a lot of people kind of put it out there as voodoo, as, crystal ball type magic. And it's not, and we see a million forms of technical analysis, lines all over graphs. Every technical analyst is right in hindsight, but it's much harder going forward. But it's clues that, nothing's foolproof, but they provide us clues. They let us know where there's a lot of interest, where, if a stock's bouncing up, keeps bouncing off 50, there's clearly a lot of buying interest at the 50 price.
There you go. And, Quick break. We'll be right back after the break and let Mike finish. Bye.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, sorry, I had to cut Mike off at the break there. Again, we broadcast live on a radio station, so we have a hard break that we come up on at the radio station. So basically, we have to match that break for the radio show. But when we start our own, if we ever start a standalone podcast, we won't have that issue. So we'll deal with that then. Real quick, just to finish that thought up, Mike, and then I want to touch on some opportunities with interest rates and something that we've done in our portfolio here recently to take advantage of a decline in rates on the equity side of the portfolio. But go ahead and finish up your comment. You were talking about the 50-day moving average.
Well, I was just saying that, at the end of the day, there's buyers, there's sellers, they're interested at certain prices. When prices move, they're either making money or they're losing money. That affects their emotions, their behaviors, and it can result in some very straight lines on a graph that are support or resistance. It makes a lot of sense, but you have to take the time to appreciate what it's telling you and appreciate that most often that technical lines are great until they're not. It's a tool. It's like fundamentals. There are a lot of tools, and you have to just make sure you understand all the tools in the toolbox and when to use each one.
And most importantly, you have to adhere. Just like being a fundamental investor is that if I'm going to be a fundamental investor, which Mike and I are, at the very end of the day, Mike and I are fundamental investors. And so as fundamental investors, we have to adhere to the fundamentals. And so you can't ignore what your discipline is. So if you're a fundamental investor, you have a discipline, you have a process of selecting stocks based on fundamentals. And you can't just, I'm going to throw that out today because, I don't like that today. It doesn't fit my narrative, so I'm going to forget price to sales, whatever it is. It's the same thing with technicals. Technical analysis works, and the reason that technical analysis doesn't work for most people is that they don't adhere to a process. They don't have a strict process of following support and resistance and breakouts and these type of things, and they come up with other reasons. Well, yeah, stocks are breaking out to all-time highs, but there's all these other reasons why we shouldn't buy it here because, we can come up with all these things. So, but again, the benefit of analysis and what's important about analysis is that you build an investment discipline around it and stay true to it. You may not agree with it emotionally, but this is where we go back to talking about emotions. and how our emotions drive bad investment behaviors. We get tied to some thesis, the debt and the deficits, and that's why, this is happening is because of the debts and deficits. We've had debts and deficits for 40 years. So, that's not real. That's a thesis, but it's not what's driving markets. What drives markets, as we've said earlier, is flows. Are people buying assets? And right now we have too much money chasing too few assets. If you didn't know this, by the way, we have roughly about 50% less publicly traded companies than we had 20 years ago through mergers, acquisitions, buyouts, going private, like Twitter went private, bankruptcies, etc. But there's 4,000 fewer less companies than we had 20 years ago. So there is a lot of money chasing 4,000 fewer companies. There's a lot of money chasing less commodities because commodities are all traded on futures. So you have so much money chasing so few assets that it just kind of keeps driving prices higher over time. And that's why technicals become very important to your overall game plan, at least incorporating some basis of that into your analysis. If you're managing your own portfolio, you should really have some very it doesn't have to be complicated. Again, we'll do a very basic show maybe next Thursday or something on technical analysis, just as Mike was talking about 50-day moving average, 200-day moving average. What does it mean? Relative strength, the same things that we go on, every day that I touch on in our before the bell commentary, right? Negative divergences, those type of things. We'll touch on some of those things. But if you don't incorporate that, it really kind of handicaps you into navigating markets over time, because now you're entirely tied up into the emotional side of you're tied up into headlines, and you're only reading bearish headlines as an example. So you think the world's about to end, and that's why you're buying this asset, because right now it's confirming that thesis. That will change. That thesis is going to change at some point in the future. Technicals will tell you that change is coming long before the headlines pick it up. So, but Mike, real quick, two questions here. One, yes, interest rates have been going up. We've been looking for a corrective opportunity to, add to, our bond portfolio. We actually did some of that this week. We shifted some of our T-bill and chill money into a kind of not long duration, but kind of medium term duration bonds. We're going to continue that process and also start increasing potentially some of our longer duration bond exposure as well. But then also we took advantage of potentially the Fed rate cut in a particular equity that may benefit from lower rates as we go forward because of simply what happens in the mortgage market. So can you talk about both of those real quick?
Yeah, so we shifted a little duration, increased our duration a little bit. Our total net exposure is still the same, but if rates come down, the higher the duration, the more price gain. So we made a little shift, and we plan on doing more, probably doing in baby steps as this market decline kind of shows itself and we get more comfortable that a bottom is near. And we are starting to. A lot of the overbought signals are no longer overbought. They're more at fair value. So now the question is, will they kind of linger at fair value and then will yields start falling again, or will they become oversold? And that's just what we're waiting for the market to tell us. And again, PCE tomorrow and certainly the labor data next week will probably go a long way to determining the trend for the next week or two. So one of the things that one of the types of securities that tends to do very well in a down yield market, and especially a bull steepening market, is agency REITs. Now, bull steepening means that long-term and short-term yields are falling, but short-term yields are falling quicker. And that's exactly what's going on now. So the yield curve starts going like that. If this is a 2-year yield and that's a 10-year yield, you start getting a shift. So for entities that tend to borrow short and lend long, that is a positive factor. So you may be saying, well, why do banks do poorly sometimes when a bull steepener is happening? Because they also have credit risk. They're dealing with the economy, and if people don't pay their loans and go bankrupt, they can lose money. But there's a class of securities out there called agency REITs, and they're REITs, and they're basically a portfolio. And what they're doing is buying mortgage-backed securities by Fannie Mae, Freddie Mac, Ginnie Mae, primarily government guaranteed at this point since 2008-9, and they're borrowing money to do that. So very simply, what they do is they raise equity. So I go to Lance, Lance, buy $1 billion of equity in the Lebo REIT. And Lance goes, that's a great idea, Mike. And he gives me $1 billion. So I don't owe Lance anything. It's just equity. He owns the company, but it's equity. So I take that $1 billion, I buy $1 billion of mortgages, and we could just sit there all day and we could earn the 6%, and that would be great. But I take that $1 billion of mortgages I bought with his $1 billion, and I buy, say, another $5 billion of mortgages using that first $1 billion as collateral for a loan. So now with Lance's $1 billion investment, we now have $5 or $6 billion of mortgages. So now with that leverage, we can make a double-digit return. That's awesome. We're paying for the debt, which is at a lower rate than our mortgages. And if we could just end the story there, that would be great. These would be the best investments ever. But unfortunately, mortgages have a prepayment feature, right? We can take out a mortgage today, we could pay it back tomorrow. We can take out a mortgage today and we can pay an extra $20 every month for the next 2 years and then pay it off in 2 years. And what that does is it causes the duration of a mortgage-backed security to fluctuate significantly. So in my original example, if we would have bought 30-year mortgages thinking that they'd be around for 30 years and borrowed 30-year debt, all of a sudden rates go down. That may be good, but those mortgages prepay, they disappear, but our 30-year debt is still there. And if we have to go buy more mortgages, they're going to be at a much lower rate, which could potentially bankrupt us. So an agency REIT, probably the most important part of an agency REIT is the portfolio manager who's managing these changes in duration on both the asset side and the liability side and trying to make sure there aren't mismatches. But they are in a very good position to take advantage of more Fed rate cuts and a steepening yield curve. They have traditionally done very well in that environment, and they will. My article from yesterday, was it yesterday? It's yesterday already. Yeah. Kind of talks about agency REITs and what they are and the pros, the cons, the risks. I'm working on one right now that goes into a little more detail on the top 6 or 7 agency REITs that are publicly traded and dives into some of the more fundamental gauges that you should be looking at, because it's not with REITs in general, but agency REITs, it's not earnings and sales that really matter. You have things like price to book value, leverage, dividends. There's a different set of metrics that you follow, and a lot of investors just aren't as up to speed on some of that. So my article, hopefully next week, maybe the week after, will go into some detail on these top REITs.
Perfect.
And what the kind of risk and reward they offer.
All right.
That may help.
Yeah, absolutely. All right, so get by the website. Be sure and like the YouTube channel. We appreciate it. Hit that like button. There's over 700 of you here. We've only got 200 likes, so come on, hit the like button for us. Appreciate it. Also, join us over on Substack as well and Twitter for our kind of daily market updates that we do there every day as well. So again, lots of place for you to get lots of free advice. Go to the website, realinvestmentadvice.com. Check all of it out. And we'll see you back here tomorrow for Financial Fitness Friday with Danny Ratliff and Richard Russo. Have a great day.